Monday, March 10th, 2025, almost 9 o'clock on this fine morning. Talk quick about the market. Some names I'm looking at go from there. S&P futures giving back the gains from Friday. Seems like a um, deja vu scenario. Every time we seem to find some reversals, the market uh, gaps lower the next session. S&P is right at its 200-day moving average. And going to be an interesting week for sure. I'm not saying it's going to dictate where the market goes over the next couple weeks and months, but you probably want to see the market find some footing here, or maybe this can be a longer period or longer duration of downturn. This week, I mean, there's still plenty of earnings, but the big data piece will be Wednesday CPI data, which has got a ton more eyeballs on it than it's had, especially with what's going on with the tariffs, with the layoffs, government cuts, things like that. Uh, I think, and I put on the watch list, I think the best way to describe the current market environment, it's like all the different catalysts are under the umbrella of uncertainty, right? So who knows the ramifications of the tariffs? Who knows the ramifications of all the cuts, the government cuts? Who knows the ramifications of the consumer confidence, all that stuff. We don't. No one knows. I think for 100% certain. And then the headline in the Wall Street Journal this morning, or at least one of the headlines, is market futures are lower as POTUS can't rule out a recession with tariffs. It's like, is that why we're down? Who knows if that's where it's so that's kind of I wouldn't say the scary part, but when you see the market moving outside of like a major catalyst, at least last week we had the announcement of the crypto reserve and things like that that at least got markets rallying at the open. This today we got nothing. So that's the big data piece. Earnings Oracle. Some other names reporting. I'm trying to think of some of the other major names. And then to me, it's all about the supports, right? So Nasdaq within from February 19th to Friday went from all-time highs to correction territory. So that happened quick, and it's at its 200-day moving average. So I think that's kind of what I think will be the theme this week. So watching areas I put on a watch list, you watch that 569 is the 200-day moving average now on the SPY. You have 563, those October lows I keep talking about. And then on the flip side, we had 575, and we closed at 575.92 on Friday. That looks like a key support resistance area. And then if we do get some reversals today and tomorrow with a 584 handle. Here's the thing, and it's like you can look at all these the charts and everything, but the media and the financial media especially just has these great headlines, and MarketWatch is always the best. It's like they ran out of crash articles, so now they have flash crash articles. Not only are we going to crash, we're going to have a flash crash, right? I mean, most of these pundits and folks who says Wall Street's biggest bulls now say flash crash can't be ruled out, but it's like uh, most of the people who come up with these headlines or articles, and they'll quote some person who called a 2008 financial crisis, but they've also called the 2010, 2011, 2012. If you get my point, I always say this, they called 37 of the last 3 bear markets, right? So eventually, some point they'll be right. But not only are they calling for a crash, they're calling for a flash crash, right? How many flash crashes have we had in our lifetime? If everybody remembers the flash crash, I don't know, was that 2010? I remember I had Apple puts, but long stories back in the day. But um, we have systems in place to prevent that now, right? So anyway, I always try to keep things in perspective in regards to historicals. I had that nice chart from Friday in regards to the amount of times the S&P has closed under its 200 or moved under its 200-day moving average since 2009. Of those, I think it's like 16 instances. The market has been up over 17% on average over those a year later. So I mean, you take that in consideration. That's pretty good in regards to history. And of course, there's always anomalies. The market could be down 17% from there. But if you're looking at history is a pretty good indicator of the future most times. That's a good sign. And also a nice chart here. I think this is from Bloomberg in regards to the amount of times that the market has closed up 20%. And I think there's 12, 11 instances since 1992. The next year, this is the seasonality chart. So how the market has performed. And you look, ironically enough, we're pretty much right near the lows. We get choppy into the end of March. And then, yeah, it looks pretty good. So always keep things in context, because it's very easy to get into these scenario where people think that the market's going to crash, right? And maybe it does. And, again, on the watch list, it's to me, it's especially in this environment, it's always important to be even more important to be hedging because small becomes big very quickly and big becomes small. Keep saying that last week too. But also, if you have some puts, you don't need much in the way of puts to, if we do have a flash crash, for example, volatility is going to go through the roof. So even just as a function of that, your puts are going to go up, and then the market's going to sell off. So it's a double whammy. And if, over times, and you'll see me. I mean, I haven't talked about it much, but these 3-time bear ETFs, I have memories of 2008, and I'd watch SKF or FAS back when these 3-time ETFs and 2-time ETFs were pretty much a new vehicle. I remember staring at SKF; it was like $20 one week, and then 2 weeks later, it's at 600 and some dollars. So, I mean, if we do get some kind of crazy pull, those are the kind of things that happen. Always in the back of my head. And then when we get downturns, I always look like FAS. I think FAS was like $10, went all the way up to 200. I'm not saying we're getting to the snare of 2008 at all, but that's why it's important to always be hedging because those things can happen. So that's the overall market. And then just last, the Forex market is not, I haven't traded. Back in the day, the leverage used to be crazy on Forex. You could get like, you could get like $1 to 200. It was 200 to 1 leverage or something. And then they got rid of that. I don't know if people got blown up. And it was very tough to trade because if you trade on that 200 leverage, you get stopped out quick. And next thing you know, your account's gone. But when you look in regards to the Forex, the US dollar was off almost 4% last week, which is like a monster move in the Forex market. So hopefully, I hate to see large swings, but we'll see what happens here if things play out. All right, so that's the overall market. So just individual names. First, I'll talk about Redfin, and I mean, who you can't make it up all the way down to $5 or under $5 on Friday, and then Rocket's going to buy him out. Rocket Mortgage going to buy him out for $12.50. Who knows if there's going to be some kind of bidding war, hopefully, or I mean, I would like to see that, but I still have some March strikes. They'll probably still be on the, I don't even know if they'll have a bid at the open. We'll see. But if it does start to melt up near that 12 handle, they might come back to life. Funny enough, the Redfin was one of my top 5 stocks in 2020. So another one of those top 5 stocks that have been acquired. Shutterstock was another one that had M&A with Getty. So I have to go do the math. It's over 30-some% now that of my top 5 stocks have been acquired. It's just some of those haven't been acquired for a premium of where I started having as one of my top 5 stocks, but still pretty good odds there. So that's Redfin. So the good thing is I won't have to be trading it anymore, so I could take that off my watch list. But happy to see I had the right idea. I was posted in the middle of February in regards to Zillow, possibly maybe some M&A rumors, and it turned out to be a different company. All right, so now on to other names. And last week, I mean, it was this time that last week I was on the rant, and then I got JP Morgan puts at the end of the day on Monday, and those paid out handsomely. You take a look, some of these names are down quite a bit, but in the whole context of things, it's like 50% of the stocks in the S&P are at their 200-day moving average. So I think there's still opportunity if the market has some weakness for some other names to start to get under their 200-day moving average. Names like JP Morgan, the Visas, the MasterCards. Look, JP Morgan, 225 is its 200-day moving average. So I'm not saying it can't bounce at some point, but if there is more weakness in the market, those are the names that haven't really succumbed to the overall market weakness. So opportunities there for put hedges on JP Morgan down to 225. Goldman spectacular under 230. And then you take a look at a name like Visa, which was actually held up relatively well on Friday, but it had one of its worst weeks in quite some time. Its 50-day moving average down there just crossed over it. It hasn't even crossed its 50-day moving average, right? So the 50-day on Visa is 335. So all these other names are at their 200. Visa's not even at its 50. So I think if there's any names that have more opportunity for downside, especially if it becomes one of these lower tide brings down all ships and a rising tide raises all ships, if the tide keeps coming out, I think it's going to lower all the names, and Visa and some of these names that really haven't succumbed to pressure, I think have probably the best opportunity. So that's that. And then on the flip, and Intuit and Ralph Lauren. And Ralph Lauren, I'm kicking myself last week. I think it was like 255 or so when I started looking at puts last week. Is kind of like this simply play with tariffs and names that have produce overseas, right? So a lot of the manufacturing of Ralph Lauren, their garments and all that stuff are Malaysia, Asia, China. So if you have to think some tariffs are just going to have to have some kind of impact. And when the name is up near its all-time highs, even just a little hit in their margins, you have to think. But of course, I missed out on puts last week. They only have the March strikes, so don't be surprised. I mean, I'll wait here, but it could be a name that moves down. Maybe it breaks under 220 today. So I'll be watching that. And same with Intuit. And then on the flip side, there's been names with relative strength, names that have started to bounce off the bottoms. I've mentioned Caterpillar and URI. And Caterpillar, I was able to get the calls at the end of the week. Traded nicely. URI still looks like it's finding a floor. That might be a nice move trade up to 650 or so if the market finds support. And then Biogen, I mean, it was up every single day last week, and not saying it's going to continue to rally, but if it finds some legs today, I might trade some calls to play for a move to 165, 170. So that's that. That's kind of overall market. And again, I think it's like very easy to get feared into just thinking the market's going to crash, and you get crash puts, and then we have what happened on Friday, right? So if you're not open to the market finding a bid, and the market find bid for no reason, right? I used to talk about, it's like the market's like a lot of the moves in the market are other people's money, right? The ETFs, the mutual funds, the hedge funds, the passive investing, the 401ks, the pension funds, all that money is not your money, right? It's other people doing what they want. It's automated programs, it's algorithms, right? So when we could have World War III break out, knock on wood, I hope that never happens, but the market might still find a bid at some point because there's money out there that just automatically goes to work all the time. So that's kind of like the beast you fight against if you're trying to play puts, because the S&P might down, the SPY might go down to 500 in the coming weeks, but it might go to 560, then up to 575, then down to 550, then up to 565, and it's tough to hold on to puts because you get killed one day and then the next day you're kicking yourself. And we saw last week with the gap lower, we had the market bounce and the gap lower, I think it was into Thursday or Friday. And then we have the similar thing here. We have the reversal green market on Friday, and now we'll have another gap down. So just things to keep in your back of the head. I keep saying I'm going to keep things small, spec puts and calls. I'm open to both sides. I won't have my bear suit on really per se until we get 563 in October is a big spot. I think if that breaks, then 540 is almost, I think that'll happen. So, and then that's correction territory. So that's it, folks. Let's have a great day. I'll be back on audio earlier than the afternoon if things get crazy. Let's have a great day. Rock and